See this pamphlet here? This is a deal that Cardone Capital just bought. It's actually a deal that I completely broke down. I'll link that video down below. But think about this for a moment. They bought the deal for just under $134 million. Here's the deed showing the purchase price, just under $134 million. Yet on this pamphlet, it says that their equity is $39.4 million, which is supposed to represent 25% equity, which means they're saying the building is worth $157 million. Wait, but he just paid $133.7 million for the deal. It says so right on this deed. How is he now giving a pamphlet to his investors saying that all of a sudden the deal is worth $157 million? That's 17.5% more. Overnight? Heck, forget overnight. The form says at acquisition, this was their equity. Are they trying to deceive new investors, or what's up with this? And maybe you're thinking, oh, well, Kevin, maybe he got a wedge deal. He got a good deal and it's worth more the day after he bought it. Unfortunately, based on the spreadsheet analysis that we did, that wasn't even close to being true. We said a marginal deal for the property would be somewhere between $130 to $145 million. Anything more than $145 would be big overpaying, and anything under $125 would be an amazing deal. He paid $133, so he paid market value for the deal and lowered his expected return just to buy the deal. Now, he might try to argue, well, I mean, we're planning on raising the rents. Well, I don't think in this kind of market, anybody's gonna be raising the rents. The units were already pretty renovated, which usually implies the rents have already been bumped. And on top of that, the property's got a little bit of a mixed review online. It looks to me like he's struggling to find deals to buy and is just parking money. But this is just the preface. This video today is about a reaction to a video he recently put out where we hear even more BS. You weren't in the 95 crash because the crash wasn't in 95. You weren't in the 2001 crash because there was no crash in 2001. And you weren't in the 2008 crash with Cardone Capital because you're sitting pretty in a luxurious mansion. Grant Cardone's misinformation and deception could end up bankrupting Cardone Capital, especially at a crazy time like this. Hi, I'm Meet Kevin. I'm that 28-year-old real estate guy who keeps bringing you information and perspective on business, psychology, making money, and real estate. I'm also that Kevin who built an over $8 million real estate portfolio with just $9,000 at 18 years old. And I'm not talking about partner or syndication money either, like Grant does when he tries to pretend what his net worth really is. Instead, today, I want to focus though on Grant's latest video on investing. And my goal isn't to just write his name or clickbait his name for views. I get those whatever. If you want to leave that comment, drop it down below and leave, that's fine. But for everybody else, I want to share with you real perspective. To me, real perspective is when somebody in an industry is able to look at somebody else's information and say, this is where they're right, this is where they're close, and this is where they miss the mark. Because guess who benefits from that? This isn't about me. To me, this is about you. That makes me happy, as when I could share that perspective and help you learn, because you could take this information and make a lot of money with it. And to me, that's a great thing. That's a great community service. And it's certainly a whole lot better than Governor Gavin Newsom telling us, all right, folks, we have a mandatory stay at home. But don't worry, we won't enforce it. So if you want to go out, you can. Yeah, he literally said that. It's pretty pathetic if you ask me. So let's get past pathetic and let's get into, I guess let's just start this video. So after some generic fear-mongering about how now stocks are red and Grant told you not to invest in stocks, you should invest with him instead, we get to minute 1 of the video, and this is actually where I want to start the video because the rest of it is too generic. So let's start right here and get into stuff we can tear apart.
That's an office building behind you. That is not what you would invest in, okay? Office buildings will get crushed. Those will get crushed. That right there will save your day, okay? If you could go buy that piece of real estate right there, good. That right there, bad. Cardone Enterprises, that's not what you want to invest in, because that is dependent upon a tenant being in business.
Yesterday, I broke down a study from Harvard for you to show you what happens when single-family real estate and multifamily real estate goes through a recession. Which one loses more value? Which one has more vacancy? Hint, hint, both of the answers there are larger scale multifamily real estate. Less tenants rent larger scale multifamily real estate during a recession. Yeah, I know that sounds ironic. There's a whole 16-minute video explaining it to you with citations. You should watch it. So pointing at a multifamily building and saying that will save your day in a recession is an inaccurate statement. Nothing really saves your day in a recession. It's all on the same ride. Honestly, you know what probably inspired this video? Is a bunch of people calling because the stock market's tanking, going, Grant, I need to get my money out of the fund. I need to take my money out. I need to withdraw everything I've invested with you, and I just want to keep it in the bank account. I want to save it right now. That's probably why he's starting with the bank account's gonna punish you. It's gonna charge you, man. Don't leave. That's why his staff's there, because they're answering the phone going, oh crap! Everybody's trying to take their money out. Everybody's panicking. How do I know that has the potential of being true? Well, look at Europe and what's happening in the United Kingdom. Real estate property funds, which is what Grant Cardone is, a real estate property fund, are freezing withdrawals because they're getting so many requests from people to take their money out because people are fearful that multifamily is going to crash again like it did in the last recession. Yet here's Grant spewing misinformation suggesting all is well, multifamily doesn't get touched in a recession. But it's a blatant misdirection, and I might even say flat out lie. Because really, he should know better.
We distributed $2 million to our investors last month. $800,000 of that went to me last month. Rental property. People have to live somewhere.
Now, just a heads up, part of me is a bit skeptical when he says, I got distributed $800,000. He kind of implies that that's cash flow. It's like, oh, damn, dude, you got 800 grand in cash flow last month? Man, let me give you some money. I want 800 grand in cash flow too. Like, I get it. That sounds cool. But knowing Grant, having experienced how Grant phrases what he says and the way his business actually operates, the odds are his $800,000 was probably a lot more like, I got $20,000 or $50,000 in distributions from Cardone Capital, but we bought $75 million worth of a real estate deal, and because I get paid a 1% placement fee, $75 million times 1%, that's $750,000 just for buying a deal. That's like a really highly paid real estate agent. And the interesting thing is, Grant Cardone doesn't get paid based on how good of a deal he got. He doesn't get paid on how much below market value he bought that $75 million deal or how much over market value he paid for the deal. He gets paid on just straight up 1% of whatever money he placed, that is whatever real estate he bought. Here's 1%. It's in his fund's documents. There's no secret about that. But the point here is, notice how he's suggesting, I distributed money to investors in the same sentence as, I also took a distribution. But he's not telling you that part of that distribution is probably, I'm not certain, but I'm almost certain, because of his placement fees, which is totally ridiculous. By the way, quick note, I extended the sale on the programs I have linked below, which are great study-at-home material, especially during this time where we're kind of stuck at home. You could learn how to open and run a property management company and do property management yourself, learn about money and the psychology of money, become a real estate agent, heck, learn how to invest in real estate yourself and make good money. I don't run a fund, I don't operate a fund, so I'm not trying to compete with Cardone Capital. If you want to invest with Cardone Capital, that's fine. Just use this as sort of free information and free guidance for you. But all I ask is you consider the links down below if you'd like. And otherwise, let's get back to the video.
Rental property. People have to live somewhere. They have to drink water. They have to eat food, okay? They need entertainment. So they're going to buy Netflix. They're going to watch their Apple TV. They're going to keep their telephone. They're going to drink water. They're going to drink food. They're going to have food delivered to the house. Maybe they're not going to go to a restaurant for a couple months, but they're going to have to live someplace.
So here's the deception with what Grant just said. He said, tenants have to live somewhere. Yeah, they might not go spend money at retail, but they have to live somewhere. So he's drawing this parallel that, well, because people have to live somewhere, they're going to rent from me. But that's not actually how the market works. See, in tough times, like I mentioned with the Harvard research, not only do tenants' rental burdens go up, how much money they have to spend on rent, not only does that go up as a percentage of what they take home, but according to the Brookings Institute, guess what poorer tenants are forced to do during tough times? They move. And they don't get to move across the country. The University of North Carolina already researched that and found, no, during tough times, people aren't going to move across the country and move to different areas. But what they are going to do is they're going to move to poorer neighborhoods with higher poverty rates, higher crime, poorer schools, and ultimately less financial success in those communities. So what does that mean? That means, yeah, Grant, during the next crash, you're going to lose a lot of tenants from your properties because those tenants are going to have to move to lower income areas. In fact, I was in Detroit last year and I went through a very high poverty neighborhood. And I went through this neighborhood because one of the houses had caught fire. And while I was there, an arsonist set fire to not just that house, but to 2 more houses. So 3 houses had caught fire within about 45 minutes. And here's what a local resident said when I asked them, essentially, why they moved here.
Yeah, I'm just wondering, so you said you just moved into the area. How long you been out here?
I've been over here for 3 months.
For 3 months. So where'd you come from?
I come from Southwest.
From Southwest. And why'd you move here?
Why'd I move here? Out of necessity.
Are the prices cheaper here then, or rents, or what is it?
Yeah, rent's a little cheaper when you're dealing with private landlords.
Okay, so you try to go directly to the landlords and negotiate a deal with them?
Yes, property management is way too high. I mean, why does a 1-bedroom cost as much as a 3-bedroom brick?
Got it. And now, how many fires have you seen since you've been here?
Since I've been here, let's see, 8 in 3 months.
8 fires in 3 months?
In a 4-block radius.
Oh my gosh.
There's only 5 houses left on my block, corner to corner.
Are they just individually burning down?
Yeah.
And what do you think the cause of this is?
Well, after what I just witnessed, coming over, watching one house over here burning, and then us standing here and this house kick up over here, as the police are here in 4 trucks, we're all standing here as you came and ran, that ignited as we're standing here. I'm sorry, but that's too coincidental. It's a firebug.
Wow.
Period.
That's incredible, man. I'm so sorry to hear that.
When a recession hits, tenants become poorer and they have to leave even the apartments that they're in and go to lower income and lower expense areas. This really sucks for them because they end up getting stuck in what's known as the poverty trap. But Grant, they're not going to be renting from you anymore, which means you will have higher vacancy.
So the reason I don't like your house is because it doesn't produce cash flow. If you have a house already, what you could consider doing and might want to consider doing is getting a loan, refinancing your house at 2 or 2.5%, and use the equity to get invested in cash flow.
It's just so frustrating when Grant Cardone does this style of talking where he suggests, oh, well, you know, I don't like your house because it doesn't produce cash flow. Yeah, we get it. But neither does your house that you live in and that you own. Because like you said, Grant, everybody has to live somewhere. And that's called the cost of living. Unless you're renting your house out to roommates, your house doesn't create cash flow. We got it. But that doesn't mean it doesn't have the potential of producing cash flow. That doesn't mean you can't move out of your house and turn it into a rental. But you happen to know that very well because you've made a lot of money off single-family real estate. But we talked about that in the last video. Today, we're talking about multifamily. I'm also not the biggest fan of taking out debt to invest in somebody's fund who's not telling you about the downside risk. Oh well,
On your own, go do it on your own, okay? You want to go buy that property right there? That one right there, all the way down that block. It covers that entire block. It's full of tenants. Those tenants aren't going anyplace. Those tenants are...
Okay, I'm sorry to keep pausing so much, but think about what he just said. That's actually really fascinating how he's manipulating here. That's a good one. Oh my gosh. He goes, oh, you see this building over here? You want to buy that building? The one that goes all the way down the block? Notice that emphasis he put on all the way down the block? He did that on purpose to intimidate you. By overemphasizing, you want to do it yourself? You could go buy that building. Look, it goes all the way over there. You want to go try. He knows you're going to look at that and go, oh, crap. I don't even know the first move to do that. And now he switched to this intimidation tactic. So we've got misinformation, and now we've transitioned to intimidation to make you feel like he's the only option.
Look, I've been through this before, folks. I'm 62 years old. I've been through this more than once. I survived 1995. Most of you don't even know what happened in 1995.
Duh! Oh my gosh. Okay, hold on. Oh, this is bad. Grant just said that he survived 1995. But wait a minute. Nothing actually happened in 1995. Nobody talks about it because nothing happened in 95. The last market peak before 1995 was in 1989, and the recession was between 1990 and 1991. Grant Cardone seems to think that something big happened in 1995, which we could take a look here at some charts and see, oh, wait a minute. Prices in real estate fell in 89, 90, 91. They bottomed out in about 94, 95. But usually when somebody says, oh, I survived the crash, they don't say, hey guys, I survived 2012. Really? So did everybody else who bought stocks or real estate. No, you say, I survived 2008 because that's when the crash happened, not when the bottom was. I personally believe that a savvy real estate investor in the 80s and 90s would know when the crash was. So just a note, after filming this, I ended up deciding to call my father-in-law because I was sort of reviewing this footage and I realized, well, wait a minute, let me just call my father-in-law out of the blue and see when he thinks the crash period was and what the bad years were. So here's that. What, you started real estate, what, in like 84?
84, January 1st, 84.
What were the big recessions?
Big recessions was from 88, which November of 88, I predicted we started seeing a change, but then the real recession that everybody says from 89 to 1994.
Okay.
And then the Great Recession. You know, there was the dot-com bubble, but that really didn't affect our real estate thing.
I don't even know what happened in 1995. The pundits on TV don't even talk about it. It was the credit and loan debacle.
Oh, dude. Okay. More evidence that he either doesn't know what he's talking about or is just confused and unwilling to consider what facts are. It was called the savings and loan crisis, not the credit and loan debacle. The SNL crisis, and no, not like SNL, like Saturday Night Live, S&L, savings and loan crisis. Oh.
1,600 banks went underwater. 2001,
Yeah.
I survived that. 2008, I survived it.
Dude, okay, well, first of all, there he is saying 2008. That is a legit crash. That's cool. Okay, we'll talk about that in a second. 2001? Nothing happened in 2001. Yeah, we had the dot-com bubble, which affected stocks. Yeah, there was 9/11, but real estate maybe saw a little bit of a flattening in prices, but there was no real estate crash in 2001. This leads me to believe that he wasn't a heavy real estate investor in the 90s or 2001 at all. Let's talk about 2008 though. Grant Cardone owned a luxurious mansion in the Hollywood Hills that made him over $1 million per year that he invested in that property. From, I think it was 2003 to 2012, roughly 10 years, he made over $10 million in profit with a single family house, which when he sold that house, was able to use those profits to start Cardone Capital. There's no record of Grant Cardone owning a bunch of big multifamily real estate heavy hitter investments in 2008. So he's telling you, hey, I survived the 2008 financial crisis. You should survive it as well. Okay, so we should all go buy single family houses because you weren't in the 95 crash because the crash wasn't in 95. You weren't in the 2001 crash because there was no crash in 2001. And you weren't in the 2008 crash with Cardone Capital because you were sitting pretty in a luxurious mansion making $1 million a year. That's $1 million a year in property value increases, not income. The property went up through the recession, an average of $1 million per year. Dude, this is the biggest BS manipulation. This is the stuff that just pisses me off because it's just straight up lying to people. Why? Why is that necessary to lie to people to close a deal? What the
thing that we're going through right now is bigger than 9/11, 2000, 1995, all combined. Plus you could add Sandy and Katrina to it. This is enormous.
Wait, what? Wait a minute. He's saying that the debacle we're going through right now, the crisis we're going through right now, is worse than all of the other recessions he's been through, quote unquote, and multiply that by the magnitude of 2 hurricanes, and that's how bad this thing is that we're gonna be going through? Well, oh my gosh, everybody better get their money out of Cardone Capital, because if that Harvard study is correct and multifamily real estate lost 40% of its value during the Great Recession, substantially more than single family real estate lost, and up on the same levels as what retail and commercial real estate lost, thanks to rampant speculation in multifamily real estate, you better get your money out of Cardone Capital, because if this recession's gonna be worse than those, Grant ain't gonna save you. He's gonna take his fee when you try to take your money out, and then laugh about it on his way to retirement.
Take your cash out of the banks that might not be solvent in the future.
Are you kidding me? Oh my gosh, now he's somehow casting jade over FDIC insurance where your money is secured up to $250,000 per bank. What? The bank might not be solvent, but we're supposed to believe you? Oh my gosh, man, this is hardcore sales here.
Take your cash out of the banks and get invested in real assets. If you can go buy them yourself, go buy them yourself, okay? If you need a partner like me, because I know what I'm doing, I've been doing it 30 years.
If you want, maybe you'll talk for a little bit. Just
Locations are vital. The location you pick is vital. Not just today, but 3 years, 5 years, 10 years from now. The cash flow, you gotta have a certain amount of cash flow based on a certain amount of vacancy, because you're gonna have vacancy. We figure down to about 85%. That means with 15% not occupied, we still cash flow and still pay our investors. Okay, so you also have to know how to get great debt. Our last loan was 3.13%. 10 years interest only, so we have stability the entire time we own it. The last thing I need to tell you is when you invest.
Oh, no. That's not stability. Let me tell you how interest-only loans work. Basically, you go to the bank and you borrow money. Ordinarily, when you buy real estate, you pay the bank back a little bit every single month, so that outstanding loan gets smaller, and eventually that loan is paid off. Instead, when you take an interest-only loan, basically, Grant Cardone says, hey, you know what? Let's just keep that loan full. Who cares about paying off the loan? Let's instead take that money that we were going to use to pay the loan off and give it to our investors. And we'll call that their dividend, like 4% or 5% or 6%. So really, instead of paying off the properties to increase everybody's safety, he's just distributing everything as dividends, pretty much to continually get more investors for his fund, which is sad. In fact, look at this person who invested $15,000 in Cardone Capital and is jumping up and down over his dividends here, saying, well, since I'm getting paid, it must not be a scam.
Scam or anything like that. I'm actually receiving payments, and if it was just a scam, I doubt that it would be paying, immediately back.
Yeah, that's exactly what all the people investing with Bernie Madoff said in his Ponzi scheme. Since I'm getting paid, must not be a scam. I'm not saying Grant Cardone is a scam, but you gotta be aware of the deception. And not only is that sad, but he's getting 10-year financing, which is exactly what Harvard found was extremely risky. Because what happens if in 10 years, you're in a year like 2007, 8, 9, 10, or 11? Oh crap. That's a 5-year period where it was next to impossible to refinance your multifamily real estate. People had to bail out of their multifamily properties at a loss because of these stupid 10-year terms. Look, 10-year interest only works great when the market's peachy. But seriously, you're signing up for interest-only debt so you can place people's money into real estate and pretend they're getting cash flow when they're just getting what you should have been paying down on the loan? Really? Right before a crisis? Man.
Yeah, I need my money. I gotta buy a Rolex. Dude, if you're really, ladies and gentlemen, if you're trying to...
Wait. I guarantee you, he's been literally getting calls like that. Oh my God, I need to take my money out of your fund, man. The market's going bad. The market's going bad. I know, but I swear, I told my daddy I was gonna buy a Rolex. Like we've been doing good. I just need to take my money out. I bet you that's what motivated this video. He's getting hammered. Ooh, interesting. Now remember, Cardone Capital's been around since the end of 2012, which the market's been straight up since then. So it's very easy to look at the past and go, look how well we did. Invest with us, we could make that money going forward. But Grant said himself, he's 62. So next crash, Grant's gonna retire. I see Cardone Capital going away and he's laughing his way to the bank. I'm sorry if this sounds harsh. I just don't trust stuff like this. Thanks so much for watching. Really appreciate you. Follow me on Instagram. Until next time.